HMRC is watching 5 things the moment you retire, and if you get any of them wrong, you will receive a tax bill you were not expecting. In the first 3 months of 2026 alone, HMRC repaid roughly £44 million of over-deducted pension tax. That is £44 million taken from pensioners who were charged too much because nobody explained how the system actually works when you stop earning a salary and start drawing a pension. Here are the 5 things HMRC is watching after you retire, and how to make sure every one of them works in your favor instead of against you. Number 1 is the emergency tax trap on your first pension withdrawal. The moment you take your first payment from a pension drawdown, your pension provider needs a tax code from HMRC to know how much tax to deduct. If HMRC has not issued your provider with a current tax code, and in many cases they have not because you have only just retired, your provider will apply what is called an emergency tax code. An emergency tax code treats your withdrawal as if you receive that amount every single month. So, if you take £20,000 as a one-off withdrawal to cover some costs in your first year of retirement, the tax calculation treats it as if you earn £20,000 every month, which is £240,000 a year, and taxes you accordingly. On a £20,000 withdrawal, the emergency tax deduction can be over £5,000. That is £5,000 taken from your pension that you do not owe. You can claim it back from HMRC using Forms P55 or P53Z, but it takes up to 30 days, and in the meantime, that money is sitting with the government instead of in your pocket. The fix is to contact HMRC before you make your first withdrawal and ask them to issue your pension provider with the correct tax code. One phone call before the withdrawal saves you from having to chase a refund after it. I will put the details in the description. Number 2 is the Money Purchase Annual Allowance, and this one is permanent. The moment you take any taxable income from your pension through a drawdown, something irreversible happens. Your annual allowance for future pension contributions drops from £60,000 to £10,000. This is called the Money Purchase Annual Allowance, or MPAA, and once it is triggered, it cannot be undone. If you are still working part-time and your employer is paying into a pension for you, or if you plan to make large pension contributions in the future to save on tax, triggering the MPAA locks you out of doing that effectively. Taking even £1 of taxable income from drawdown triggers it permanently. The fix is to understand this before you touch your pension. If you need cash and you have not yet accessed your pension taxably, consider whether you can use your tax-free lump sum first, which is 25% of your pot and does not trigger the MPAA. Or consider whether you can use savings or other income to bridge the gap until you are sure you no longer need the higher annual allowance. Once you trigger it, there is no going back. Number 3 is the £100,000 cliff edge, and HMRC will not warn you about it. If your total income in a tax year goes above £100,000, your personal allowance starts being reduced. For every £2 of income above £100,000, you lose £1 of personal allowance. By the time your income reaches £125,140, your personal allowance is completely gone. This creates a hidden tax rate of 60% on income between $100,000 and $125,000. You pay your normal 40% income tax, plus you lose your personal allowance, which adds an effective extra 20% on top. Most people have no idea this exists. For retirees, this matters because a large pension withdrawal in a single year can push you over the $100,000 threshold. If your state pension is $12,500, your private pension income is $60,000, and you take a £40,000 drawdown withdrawal to pay for a new car or home improvements, your total income is $112,500. That £40,000 withdrawal just cost you far more in tax than it needed to because it pushed you into the 60% trap. The fix is to spread large withdrawals across multiple tax years. Take $20,000 this year and $20,000 next year instead of $40,000 in one year. The total amount is the same, but the tax bill can be thousands of pounds lower. This is basic pension drawdown planning, and HMRC will never suggest it to you. Number 4 is the state pension and personal allowance squeeze. The full new state pension in 2026 is £12,547. The personal allowance is £12,570. That leaves a gap of just £22. £22 between your state pension and the point where every additional penny of income is taxed. This means if you have any other income at all, private pension, part-time job, savings interest, rental income, virtually all of it will be taxed at a minimum of 20%. A retiree who assumed their modest private pension would be partly covered by the personal allowance discovers that the state pension has already used up almost all of it. HMRC does not send you a letter explaining this. They adjust your tax code on your private pension to collect the tax. And most people only notice when their private pension payment is lower than they expected. The fix is to check your tax code carefully. Make sure HMRC has applied your full personal allowance to the right income source. If your tax code looks wrong, call them. Number 5 is the pension inheritance tax change coming in April 2027. And this is the one that will cost families the most money if they do not act. Right now, if you die with money left in your pension, your beneficiaries can inherit it without paying inheritance tax. Pensions have been completely outside the inheritance tax system. That is why one of the most common retirement strategies for the last decade has been to leave your pension untouched, live off other assets, and pass the pension pot to your children tax efficiently. From the 6th of April 2027, that changes. Unused pension funds will be included in the value of your estate when calculating inheritance tax. The inheritance tax rate is 40% above the nil rate band. If your estate, including your pension pot, exceeds the nil rate band, your family could face a bill that wipes out a significant portion of what you intended to leave them. There are exemptions. Pensions passing to a surviving spouse or civil partner remain exempt. Dependent pensions paid to a surviving spouse or child are outside the scope. But the general rule from April 2027 is that your unused pension pot is now part of your taxable estate. This changes the entire calculus of retirement spending and estate planning. The old advice of preserving your pension and spending other assets first may no longer be the right strategy. Whether it makes sense to draw down your pension faster, to use your tax-free lump sum, or to restructure your estate plan depends on your specific numbers. This needs professional advice, and you have less than 10 months before the new rules take effect. Let me bring all 5 together, because the pattern is the same across every one of them. HMRC does not call you when you retire and explain what changed. They do not send a letter saying your first withdrawal will be emergency taxed. They do not warn you about the MPAA. They do not flag the 100,000 cliff edge. They do not explain that your state pension has eaten your personal allowance. And they will not remind you that your pension pot is about to become part of your taxable estate. The system assumes you know, and if you do not know, you pay more. I will put every form, every phone number, and every link in the description below. Send this video to one person who is about to retire or who recently retired and has not checked any of this. A spouse, a parent, a friend, a colleague, because HMRC is already watching their pension. The question is whether they are watching HMRC back. I will see you in the next one.